Good morning, good afternoon, good evening, all of those who are joining us. Thank you so much. For those of you who joined us on our last webinar, welcome back. For those of you who are joining us for the first time, thank you so much for taking the time to be with us today. Today, we'll tackle some of the most pressing questions facing industry. How much will a nuclear project cost? Is it risky? Which reactor type offers the best value? So we'll explore those critical economic factors that shape nuclear technology decisions, from capital costs and market dynamics. This session will illuminate how these elements tie into the bigger picture of financial risk and how their interplay can influence investment outcomes. You'll also be introduced to practical tools and methodologies for techno-economic assessment, cost analysis, energy demand forecasting, and evaluating market uncertainty. Skills that are essential whether you're comparing reactor designs or planning deployment strategies. After the presentation, the IFNEC Secretariat will walk us through the key logistics of the upcoming IFNEC Advanced Reactor Workshop in Idaho Falls. So if we could have the registered participants kindly remain after the presentation, we're going to give you a quick overview of the logistics so that you will be up to date on the most current information. So for today's presentation, to ensure a stable connection and considering the large number of registered participants, your video and audio functions have been disabled. You can still actively participate in the discussion by using the chat function, by expressing your views in the Q&A feature, and by raising your hand. Please note that we may not have enough time to accommodate all the questions, but we would like to get to as many as possible. Today's session is being recorded, and the recording will be made available online in the near future. So without further ado, I would like to provide an introduction of Dr. Jason Hansen, who will be our presenter today. Jason is a distinguished research economist, holds a PhD in environmental and natural resource economics from the University of New Mexico. He practices as an energy economist at the Idaho National Laboratory, which is DOE's premier national laboratory, and he focuses primarily on the economics of nuclear energy. He has led studies investigating the economic implications of transitioning coal power plants to nuclear plants, financial risk analysis in nuclear construction, and studies to maintain a cost database on cost in the nuclear fuel cycle, just to name a few. Prior to focusing exclusively on nuclear energy, Dr. Hansen worked in bioenergy, where his research addressed financial risk in supply chain logistics. Jason's work appears in numerous peer-reviewed journals, conference proceedings, technical reports, and book chapters, totaling in excess of 50 publications. Jason continues to teach principles courses as adjunct faculty and night classes at his local university. I am very pleased to welcome Jason to yet another event that we have worked on. He is a dynamic speaker and really will break this down for you in a way that is easily understandable. Jason, thank you for joining us again. Over to you.
Thank you, Aleshia. Appreciate the invitation. For some reason, I'm having a hard time getting my video to turn on, but it looks like the audio may be working. So I'll just go with audio. Okay, there's the video. Thank you. Well, thanks for the invitation to talk a little bit about some of the things that we're working on here with respect to economics and finance implications of different types of technology associated with nuclear power. I prepared some slides to walk through today, so I'm going to begin the screen on those. The reason that economics is a pretty fascinating discipline is because, in my opinion, it's the science of common sense. It's how everything comes together to form a picture about how an item or a service or a good or a system creates value for society. And nuclear power does create value for society in many different ways. And so really the question becomes, how does that value get transmitted to different components of an economic system? And that's what I'd like to talk with you about today, because in order for nuclear power to be deployed, for it to be used in our country successfully, not only does the technology have to stand up to scrutiny, but so do the economics. And so what I've prepared today is a discussion about a framework for thinking about what are the different components of technology and how do those different components impact on economic consequences. And so as Aleshia mentioned, there's some questions that I'd like to go through and answer. So when we think about economics, there's many things come to mind, I'm sure, when somebody asks you what are the economics of something. Certainly, I've heard many different questions asked associated with economics, but basically, the questions associated with the economics of nuclear technology are: how much will it cost? Is it risky, financially risky? When will it be ready? Which reactor offers the best value? And others that are associated with those types of general high level questions. And I would say, first and foremost, that it depends. It depends on many different factors. It depends on how a system is designed, how the question is being posed, who bears the consequences of the question that's being posed. So, in order to answer more formally the questions of how much does it cost, is it risky, when will it be ready, that's how economics as a science, as a discipline for study, can provide a great deal of usefulness for helping to determine which types of nuclear technology will work best for the different applications that we find ourselves looking at them in. So the reason for that is because economic viability it means that the different diverse set of attributes that are associated with the technology that they have they all come together. They fit together in a puzzle, you might think. And economics is how they all come together in this puzzle-like fashion. Now, one of the things that really intrigues me about economics is this second bullet point that I have listed there, that markets reward good ideas and punish bad ideas. Well, what does that mean? Well, when innovations come along that solve problems, that make people's lives better off, markets reward those, or in other words, people seek to purchase those, seek to use those technology options because they make their lives better. That creates profits, and profits motivate development. Well, if it doesn't create value for society, markets punish bad ideas. They go out of business. Nobody wants to use them. Or when a new idea comes along that replaces an old idea, that's what the famous economics professor from Harvard University, Joseph Schumpeter, called creative destruction, where a new idea comes along and we no longer need the old ideas that were previously being used. And so there's an element of creative destruction that comes along as markets filter out technologies that no longer provide value to society and advance and move forward technologies that do provide value to society. And so related to that is the notion of what's referred to as economic efficiency. And what economic efficiency drives at is that's the best value of society's, the most value given society's resources is being created. Well, what does that mean? It means a couple of different things. It means that the benefits of the technology or the benefits of the item being considered are proportional to the costs of those things being considered, that the costs do not outweigh the benefits, number one. And number two, that those who do benefit are those who are bearing the majority of the responsibility for the cost consequences associated with it. And the other element of that is that there's no other once we reach economic efficiency, there's no other allocation, or in other words, there's no other way for doing things that could make society any better off than what the economic efficient result is. So there's a lot involved with that. I mean, that's a concept that you can, as I did, gain a PhD in that in terms of understanding economic efficiency. But for our purposes, what I would like to drive home is the point that economic efficiency means that those who benefit and those who bear the costs of something are proportional, that the orders of magnitude are proportional. And the reason for that is because also in economics, we have a concept that's referred to as incentive compatibility, or in other words, people are not going to move forward with a decision. They're not going to move forward with an action if it doesn't create benefit for them. That's why I like to say that economics is the science of common sense. If it doesn't make any sense, if it doesn't create any value, why would I choose to move forward with it? Well, on a much grander scale, that's exactly the question that we're interested in when we are thinking about different types of technology. All of that to say that we're driving towards a specific point of answering the question, is it bankable? What does bankable mean? Well, what that means is this project, is this technology set up in a way that's going to attract the investment community? Does it look like it's going to be a good investment for people to find value and to invest in a technology? So thinking about answering that question, is it bankable, requires thinking about various different components, and that's what I'd like to take us through today. So on the topic of nuclear finance, that's definitely on the global agenda. Many countries are thinking about nuclear technology. I've got here a picture from COP28 where there was a pledge for tripling of nuclear capacity by many different countries. The United States recently has announced that it is interested to try to increase the amount of electricity capacity provided by nuclear power on the grid by a factor of 4 by the year 2050. So many different nations are interested in nuclear technology. So nations that have never had nuclear as part of their energy portfolio before, they're looking into nuclear technology. Countries that have nuclear technology as part of their energy mix are looking to expand it and make it go forward. Countries that have decommissioned facilities are looking to start those facilities up again. This nice painting that I have in the top right-hand corner is a picture of Diablo Canyon. That's a power plant in California in the United States. It's a plant that was going to be decommissioned. It was going to be shut down. And in fact, all plans were in place to close that power plant. But there was a decision to reverse that, to keep the power plant open. And it was driven by people, by society. One particular group that was influential in the reverse of the decision on shutting down Diablo Canyon was an organized group of, I think it was titled Mothers for Nuclear Energy. So this was a group of mothers who were concerned for the welfare of their children in the long term, asking the question, why are we going to shut down a nuclear power plant that's providing reliable, baseload, consistent electricity? Why would we shut it down? So them and others were instrumental in reversing that decision, and now Diablo Canyon will be operational for more years into the future. Okay, so I bring that up. I mentioned this example from the United States. I bring this together with the point from COP28 for the purpose of recognizing that the investment in nuclear capacity is going to explode going forward. And it's not just me saying that. The IAEA has recently come out with a publication where they looked at investment in nuclear technology historically, as well as projections of investment in nuclear technology under various different scenarios. And what the gray bar here shows on the left here is over the past 7 or 8 years or so, what has investment globally looked like in nuclear capacity? And then over the near term, medium term, and the long term, what do the projections look like for investment in nuclear capacity? And they looked at it under different scenarios. under scenarios where countries were aimed at a policy of getting more net zero type electrons on the grid, a policy of, a situation where there's a great deal of investment in nuclear capacity based on different assumptions, as well as the tripling pledge from COP28. And under those different scenarios, what do we see? Well, in the near term, by the end of this decade, it's projected that the amount of investment in nuclear technology will double. And then in the next decade, heading towards mid-century, it's expected to go from doubling up to a tripling of investment in nuclear capacity. So when I see that as an economist, I think, well, that's going to create a lot of demand for what we call loanable funds, for borrowed money. That means that there's going to increase in competition, competitive pressures for identifying nuclear projects that make economic sense, that are bankable. As more and more money is sought after to try to invest in nuclear technology, it will become increasingly important to demonstrate the economic competitiveness or the economic viability of nuclear technology. So this is an exciting time to be in the nuclear industry, and economics and understanding finance, various applications of finance, help us understand the pathway over which we can see these developments take place. Okay, so I like to start out with pictures, thinking about economic risk, a simple schematic to identify different components of technology, a technology option where there are sources of economic risk that are created. It's a simple diagram. There's probably very many more components that could contribute to economic risk, but this is a structure for helping us to systematically begin to think about, where do we need more information? What risks are involved here? What sort of strategies need to be implemented to mitigate economic risk? So first off, we start with technological risks. Okay, what's the maturity of the design that you're looking at? There are many different designs that are out there. Some are, and they're all in different stages of design maturity. Some are designs that have been demonstrated, that have been built previously. Others are designs that are under development. So the design maturity aspect is something that can contribute to economic risk. Closely tied to that is the role of regulation. Once the design gets submitted for regulation and it's reviewed for safety characteristics, are there things that need to be changed about the design? Okay, that has economic consequences associated with it. The next one has to do with scheduling performance and lead times. What's the situation with the supply chains that will support the nuclear technology that you're looking into? Do you have a workforce in your country that's ready to build a nuclear power plant? Or will you have to develop the workforce that will be needed to build and operate the nuclear power plants that you're planning? What are the supply chains that will support that nuclear construction? Do you have trade relationships established with other nations where you'll need to procure those different inputs that will be required to build the nuclear power plant and then to operate the nuclear power plant? This includes questions of sourcing fuel. Where will you get the fuel from for deploying nuclear technology in your country? And then we go to cost consequences. That's one that we think about a lot when we talk about economics, particularly because of the fact that nuclear power plants are a highly intensive capital investment. There's a large upfront fixed cost associated with building a nuclear power plant. And then by comparison, the operations and maintenance costs are relatively small going forward after that. So the costs associated with that that's a big component of economic risk, particularly when we recognize the fact that given a change in the interest rate, a 1% change in the interest rate associated with financing those capital costs can lead to up to a 5% change in the electricity costs that our customers will see. Okay, so these things are all connected and work together. And then finally, what happens in the market where the nuclear power plant will operate? Where's this notion of value? Who's getting the value from the nuclear power plant? Okay, this deals with things like market structure. Will your nuclear power plant operate in a regulated market where where the owners of the nuclear technology are guaranteed a rate of return over some fixed period of time, 20 years, 40 years. That's a different characteristic than if you're operating your power plant in a market where it's a competitive market, where it's deregulated, or another word for that is called liberalized market. Okay, that influences who's going to bear the risk. If you are operating in a rate of return regulated market, it's actually the customers that are going to be bearing the risk. Or if you are operating uh, in a competitive market, it's going to be the utilities that are bearing the risk. Okay. And then the other thing associated with market design and market outcomes has to do with what's the state of the economy where your nuclear power plant is going to be operating. Does your nuclear power plant pay off better when the economy is performing poorly? Okay, because once the technology is built, it's a relatively safe investment. Or does your technology pay off better when the economy is booming and there's a strong demand for electricity, like for data centers, for example? Okay, what are the conditions associated with the economy that are going to affect on the market outcomes where your technology is going to be operational? So risk, if we think about what the quantitative definition of risk is, this is a definition that was formalized back in the early 80s by some researchers by the name of Kaplan and Garrick, where they basically said the quantitative definition of risk is probability times consequence. Okay, well, that's probability of an unwanted event. What's the unwanted event? Well, if we're talking about cost risk, the unwanted event would be the unwanted event being the cost overrun, what was planned for. Or if we're talking about schedule risk, the unwanted event would be that the nuclear construction takes longer to build than what we planned on. Or if we're talking about technical risk, the technical risk would be that the design is not ready when we thought it was going to be ready. Or if we're talking about market risk, maybe the unwanted event is that the economic conditions where you're going to operate the power plant are different than what you expected when you were doing the analysis. Okay, so those are all ways to think about probabilities of the unwanted event. But then consequence comes along. Okay, and we can't talk about consequence without including with it a perspective. Okay, if I'm building a nuclear power plant and you're a different country and you're not building the nuclear power plant, and I have terrible economic outcomes with mine, that doesn't mean you have terrible economic outcomes. Those are my consequences, not your consequences. So what I'm getting at there is that when we think about consequences, we absolutely have to ask ourselves, whose consequences are we talking about? Who's going to bear who's going to bear the risk exposure of these things that we're identifying? Okay, that gets us into the space of thinking about who are the stakeholders that are involved. Are we talking about the consequences that a government is going to bear if this is a project that's going to be financed by the government? Or if it's a utility that's going to finance this project, are we talking about the consequences that the utility is going to face? Okay, and ultimately, if we're talking about the government or utilities, we can't go very far about talking about those entities without including in there the ratepayers who pay the utility, or the taxpayers who provide the funding for the government. Okay, or maybe we're talking about the vendors of the technology are the ones that are developing the technology, or the EPC firm, which is to say that the businesses that are the constructors, they're the ones who actually build the plant. Are those the ones who are dealing with the consequences? Okay, whose consequences are we talking about? And related to whose consequence is whose action causes the consequence. Okay, if we're over here somewhere dealing with a scheduling issue, and the action on the part of the entity over here with the scheduling issue translates to the entity over here who's bearing the cost consequences, well, here we've got a situation where those who are creating the risk are not the ones who are bearing the risk. Okay, that means we need to talk about who's benefiting. Somebody's cost overrun is somebody else's benefit. when we're thinking about this economic system, somebody who's dealing with a misfortune in terms of economics means that there's somebody else in the system who's dealing with a fortunate outcome. Okay? Well, when we introduce the notion of economic efficiency, what we're really driving home is those have got to be lined up better. Those who benefit from the technology being developed, whether it's in terms of long-term reliability or whether it's in terms of demonstrating that a design is going to be a viable design going forward, or whether it's demonstrating that as a construction firm, you know how to build a nuclear power plant. Those who benefit are also those who bear the costs, and those need to be lined up. Okay, that those benefits need to be proportional to the costs in terms of those who are responsible for paying those economic outcomes. All right, that's all part of economic efficiency and getting risks and benefits lined up in a way that makes sense for decision makers and for stakeholders to say, yeah, I do want to invest in this technology, or yeah, I am willing to take on the risk of this technology because the benefits that I stand to gain are proportional to the risks that I'm facing. So that sets up our framework for thinking about economic and financial risk. Now, let's move into talking a little bit more specifically about different components of it. We're going to start by talking about cost consequences and different ways to model cost. And then we're going to bring it home to market outcomes and talk about modeling market profitability and things of that nature. And then we're going to link that back to factors that influence that bankability question, like what's in it for the investment community. So from this point moving forward, we're not necessarily going to focus much on technical risk and scheduling risk, although keep in mind that these definitely have a bearing on market outcomes and cost outcomes. All right, so first off, talking about different components of nuclear cost. Now, I'm going to use a few equations in this slide presentation, and I can guarantee you there will not be a quiz at the end of the presentation, making sure that you understand what the first derivative of the first equation is that I'm presenting. That's not what I'm doing here. What I am doing is I want to talk about different components of these equations and how they link together, and how these different components actually bear on the economic outcomes of that bankability question. Is a project bankable, or can we structure the project in a way that we can find financing? So levelized cost of electricity is a measurement that's often used for comparing energy technologies. And for nuclear power is a capital cost intensive endeavor. It's got long lead times and it's got long periods of performance. And so when we use this levelized cost of electricity metric, this is an equation, there's some things that we need to keep in mind. Okay, first of all, levelized cost of electricity ignores what we refer to as system costs. So things like the quality of the electricity that's on the grid in terms of the frequency that's on the grid. It ignores that. In terms of the availability of reserves, it ignores that. Levelized cost of electricity ignores that. So there's some things that it ignores. So we have to be conscientious of what those limitations are when we use LCOE as a metric of comparison. But LCOE does give us that connection back into financing, where it has this tie back into the bankable question of what's in it for the investment community who's looking at this project and trying to determine, do I want to invest in this? Okay, so what are the components of the levelized cost of electricity? Well, the first one has to do with what we refer to as CapEx, or the total capital expenditures, the cost of building that nuclear plant. Okay, and then there's the operations and maintenance costs associated with building the plant. And then there's the fuel costs associated with setting up the plant, initializing the first core, and then changing out the fuel over the lifetime of the plant. And this levelized cost of electricity is also dependent on the amount of electricity the asset will generate going forward. Okay, so when we talk about this CapEx, or this investment cost, we can break this down into two different components. the overnight capital cost, OCC, which I'll talk about on the next slide. OCC says, okay, what's the total cost of the plant if we could build it in a day? What that's getting at is what's the total amount of resource that's needed, manpower, materials, equipment, all of that. What's the total amount of resources that's needed to build and operate this plant? And interest during construction gets at that financing question of how much, what will be the financing charges during the period of construction. Okay. Then this parameter right here, R, this is what we call the discount rate. And I'm going to develop that discount rate in a couple of slides later on. But that discount rate, what that's getting at is that's getting at the opportunity cost of capital, which means if an investor is putting money in the nuclear plant, that means they're not putting that money someplace else in the economy. They could be putting that money into a different energy technology. They could be putting that money into a data center. They could be putting that money straight into the stock market. There's other things that they could be doing with that money, which means that if they're investing in nuclear technology, they're giving up the opportunity to earn money someplace else in the economy. And this discount rate is capturing that opportunity cost. And then this is also evaluated over time, which is the lifetime of the facility over which the power plant is going to operate. So all of those are major components that I want you to keep in mind as we move through this conversation. Okay, so from this recent IAEA study, they created this very nice figure that shows how costs break down over different types of energy technologies. Okay, now notice there's not a scale listed over here because this is illustrating relative categories. Okay, and we're looking at here large nuclear reactors, small modular reactors, lifetime extension for plants that are already existing and operational, developing wind technology, solar technology, and combined cycle and gas. So keeping in mind these limitations that I told you about in the previous slide, that these all have different project lifetimes. So a nuclear power plant, it could operate for 80 years. Well, within that 80-year time frame, a solar farm might have to be replaced 4 times, or a wind farm might have to be replaced 3 times in the same lifetime period of the nuclear plant. So that's something to keep in mind. Capacity factor, which means how many over a certain number, over the 8,760 hours that are in a year, how many of those hours are available for producing power versus how much are they down? That's contributing here as well. So that helps us to see what these different comparisons are. So the dark blue, that shows the overnight cost, or in other words, that's the total amount of resources that are needed to build the technology. And you can see that nuclear power has large capital costs. Nuclear extensions, that relatively little capital costs for extending the life of an existing plant. Combined cycle plants, gas plants, very small capital costs, overnight costs, but the fuel costs are substantial on gas plants. Whereas for nuclear plants, the fuel cost is much less. For renewables, there's no fuel costs associated with renewables. Okay, so that gives a sense for that different breakdown. And this light blue color here, that shows the relative component that belongs to the financing charges. So, this investment question that we're talking about. So just as a summary on that, whether we're talking about fossil plants, nuclear plants, or renewables, they have different cost structures. Okay, fossil plants have low fixed costs and high variable costs, relatively cheap to build and then pretty expensive to operate going forward. Nuclear plants, pretty expensive to build, but then relatively cheap to operate going forward. Renewables, low fixed cost and low variable costs. And then for each of these, the notion of capacity factor. Fossil plants have about a 50% capacity factor, nuclear plants about a 90% capacity factor, and renewables about a 30% capacity factor, which means the amount of time that your asset is actually generating and making money. So bringing that now to connecting on the effective markets is the notion of the market structure where the power plant is going to be operating. So this is a picture from the United States, and these are different competitive markets that we have in the United States. And the reason that I want to show you this is to illustrate that as we go from one market dynamic to another, there's different energy portfolios. So we might have a lot of gas in one market and a lot of coal in a different market, or a lot of renewables in a market. Okay. Well, that competitive nature of a liberalized market, it can, in conjunction with the cost structure that I just mentioned previously, influences the economic outcomes. Versus in the United States, there are three different distinct regions that are regulated markets where there's a guaranteed rate of return. So again, thinking back to who bears the risk in a guaranteed rate of return, economic consequences are borne by the customers. Whereas in competitive markets, economic consequences are borne by the utilities. So that shifting of different risks associated with that. So this question of how much does nuclear power cost? That's the one that is often the question associated with economics. And what I would like to convey to you is that that might not be the question that we should be asking, but instead, what's the cost behavior that we should be thinking about when we look at nuclear power? The reason for that is because of this notion of economies of scale versus economies of multiples. So economies of scale means that the bigger the reactor, the lower the per unit cost. That's the notion of economies of scale. But as advanced technologies in nuclear develop, the economies of multiples comes about. Okay, well, what's the notion of economies of multiples? So with nuclear power, what that means is that for small modular reactors, for example, there's decreased construction time. And if there's decreased construction time, that means there's going to be decreased financing costs. There's the components that go into these advanced technology designs can be produced in a factory instead of built on site. There's a reduced number of components that will be required for advanced technology designs. The modular aspect of plug and play, or in other words, build them and build a plant and repeat, go on to the next one, build the same design and repeat. That contributes to the economies of multiples and the cost savings associated with new nuclear designs, as well as the fact that you can operate the new nuclear designs for longer periods before you have to refuel them. All of those are contributing to the aspect of economies of multiples. So what that means is that the cost curve for advanced technologies initially might be higher than that for large reactors. We refer to that as what's called first of a kind technologies. But over time, as a particular technology gets built, the economies of multiples kick in and that cost falls over time, so that the economies of multiples, multiple builds that get built over and over and over again, learnings kicking in, actually bears out to be a better cost advantage than the economies of multiples. So in terms of some cost data, I provide some references here where this cost data is coming from. The cost of a large nuclear power plant is approximately $5,000 per kilowatt electric. This has some, I think this is actually in 2024 data, so this could be a little outdated by now. It's probably closer to $8,000 by some recent studies that I saw recently published. But in terms of first of a kind for SMRs, that means over time, as repeated designs get built, those cost consequences come down. Now, how do you model all of this? There's some codes that are out there that I want to bring to your attention that the national laboratories have invested in. This first one is called a CERT. It's an algorithm that can be used to build a bottoms-up cost estimate, where it asks you all kinds of questions about the different natures of the technology that you're building, the size of the technology, the land footprint of the technology, and it incorporates that data and generates a cost estimate associated with it. And that's a modeling software that's available. I provide the link for it here. Another cost modeling tool is what's referred to as the cost reduction framework. So as we go from that first of a kind to that nth of a kind plant, how do things like the amount of orders bear on the cost? How does the interest rate bear on the cost? How does design completion bear on the cost? Many different factors. This is a spreadsheet model that's available at this link, and it helps you to look at what are the different pathways over which costs could evolve going forward. Then the next tool set is what's referred to as looking at market modeling tools, where you get into energy demand. So energy demand and energy supply have to be maintained in balance over the whole lifetime of the operation of the plant. Supply has to meet demand, but yet demand is very volatile. Could be due to weather or due to disruptions of various different types, or maybe there's a football game on and everybody turns on their TVs at the same time, giving a spike of demand. Or in the UK, there's what's referred to as the tea kettle effect, where everybody comes home from work and turns on their tea kettle and there's a spike in demand. Well, how is that going to be dealt with on the grid? That supply has to be instantaneous. So modeling that requires a sophisticated framework because of the uncertainty and volatility associated with that. Similarly, there's uncertainty and volatility associated with the supply. That particularly as renewables, this is what's referred to as the duck curve, where the amount of electrons that come on the grid from renewables means that electrons have to go off the grid someplace else because there's not enough demand to support it. So that creates different opportunities for economics in terms of what you can do with the power when there's this excess supply on the grid. Maybe you could use the power for creating hydrogen, or maybe you could use the power for desalinating water, or for different applications. All of those are different ways at looking at the market opportunities, and where there's a great deal of uncertainty involved with that, in terms of uncertainty of demand, uncertainty of supply, as well as the technology itself. This is a framework of tools. We refer to this as the force framework, where you can look at the technology associated with the technology that you're looking at, model the technology. You can look at the economics of the technology that you're looking at. You can look at the optimal control or real time of decision making of keeping that supply in balance. So another framework for looking at the market viability and aspects along those lines. All right, so now let's bring cost and market implications back to financing questions. Okay, so that R that I mentioned, where we were looking at the levelized cost, that's got two broadly speaking components to it. This is referred to as what's called the weighted average cost of capital. So what is it weighted by? It's weighted by the amount of debt and the amount of equity that goes into financing. Okay, so when you are thinking about attracting investment, what do you have to think of? Those who provide debt for the project, they actually have less risk exposure than those who provide equity for the project. Okay, that's because if the project fails, those who have debt in the project get paid first. So they have less risk exposure than those who provide equity. So for those who provide equity, how do we determine what sort of equity position they need? Okay, this question right here, what's the return on equity that should be considered when we're thinking about the cost of capital associated with building nuclear technology? Okay, so this next slide is the last slide of equations, and then we'll be about to wrap up. So answering that question of the equity requires thinking about how does the investment in the nuclear technology compare to other things that the investor could be doing. So this term right here, this expected return, let's think about what the components of that are. So the first component means, well, I could take my money and I could just put it into a savings account in the bank. That's a risk-free asset. Or I could invest my money into the stock market. It's another option that I could do. Or I could invest this technology into this project that we're looking at. We could invest in nuclear power. Well, if we invest in nuclear power, how is the performance of nuclear power related to the performance of the economy? So again, we don't need to memorize the second derivative of the equation or anything, but what we do need to recognize are the components, that there's a risk premium associated with that the expected return that the investors are going to require has to be thought of in terms of their opportunity cost of what else they could be doing with their money. Okay, so structuring the project means thinking about what's in it for the investment community. Is it going to be a profitable return in terms of how much is the share of exposure that the investor is going to be exposed to relative to the market return opportunities? Now, thinking about all of that, there's different ways of of structuring that. In the United States, recent experience that we have with that is in terms of the Vogel plant, where there were government loans involved. There were tax credits from the government that were involved to offset the cost and economic risks that were in that construction project. In Turkey, a recent project that happened in Turkey, they used the build, own, operate model. So the entity who built the facility is also the entity who operates the facility going forward. So that has to do with aligning the incentives in a way that is compatible with all those different stakeholder decision points that I mentioned previously. And once they built the plant, then they offered these what are referred to as purchase power agreements or contracts, you might say. So a contractual way to eliminate some of the risk by guaranteeing a market return. The Baraka facility, that was financed in part by the vendor who built the facility, the Korean agency who built the facility, as well as by the UAE themselves. And then they created purchasing power agreements to guarantee that revenue stream going forward. And then finally in Finland, there was the Mankala model, which means that there was a cost-based model where the amount of electricity that was produced, the cost associated with that could be passed on to the users of the facility based on the amount of ownership in the investment, so proportional to their investment. So again, all different ways of trying to align the incentives of those who are investing with those who are bearing the risk with those who are benefiting from the risk. And that's a picture of the Baraka facility in UAE. Okay, finally, this is a picture of what's called Arkansas One in Arkansas. I drove by that the other day and thought that was a beautiful facility. So I wanted to show a picture of it there. So economic efficiency results when the benefits are proportional to the costs, or in other words, when those who are exposed to the risks are also exposed to the benefits that are potentially available. That has to be lined up. So financing nuclear power is not only about the money aspect of it, but it's also about managing risks and structuring the contracts in a way where these incentives can be aligned, where trust can be established. Well, how do we validate that? How do we build trust? This analytical approach of understanding the costs, understanding the market opportunities, breaks it down so it becomes very transparent about where the risks are and where things need to be, where risks need to be mitigated. So keep in mind, markets reward good ideas and good projects. Ultimately, that gets at the question of, is it bankable? Can we take this to the bank? Can we take this to the investment community and find investors who are willing to invest in this project? So a lot of information, but again, economics and finance, this is where it all comes together. All of these different aspects of technology, whether we're looking at providing baseload power, or whether we need a technology that provides ramping services, or whether we're looking at it for building a data center or non-grid applications, all the different uses of the technology designs that are out there, they all come together in this question of economic and financing risk. So with that reaches the end of my presentation.
Well, thank you so much, Jason. I really appreciate the information. We have a lot of questions to go ahead and get started with. So I'll start with those that are in the Q&A function. So the first one is, how best can the cost of renewable energy sources, say solar and wind to nuclear energy? So the question is supposed to be, how best can one cost renewables like solar and wind in comparison with nuclear energy?
Yes, thank you for the question. So this is getting at that LCOE number that I talked about a few slides ago, levelized cost of electricity, where to compare the cost of nuclear power to the cost of alternatives like renewables. To do that, we need to keep in mind the limitations of the LCOE number. We have to keep in mind the capacity factor and lifetime of the project. We also have to factor in there how will the electricity be bought and sold? Will it be in a deregulated market, or will it be in a regulated market? Because that's going to bear on the economics of nuclear against the renewables and how the renewable costs are structured and enter into the marketplace.
Thank you. If we could take the QA slide down and just have Jason and myself on the screen, we don't need the QA slide right now. All right, so the next question is, could you please elaborate on the idea of proportionality in the context of economic efficiency?
Yeah,
Isn't it that benefits should always overweigh the cost?
absolutely. Benefits should always outweigh the costs. But when I'm getting at the notion of economic efficiency, those who receive the benefits or those who bear the costs should also be those who bear the benefits. That it'll be very difficult to get any stakeholder to say yes to a nuclear project if they have a tremendous amount of cost exposure and risk exposure, but no benefits in return. So that's what I mean by getting the benefits proportional to the cost, is that those who benefit should be those who are also bearing the cost or the risks associated with it.
Thank you. The next question is, how do you demonstrate to a decision maker and a company in an emerging country that economic risk is manageable in this new nuclear energy industry?
Excellent. Yeah, thank you for that question. So, the first part of it is with analysis. I mean, we simply have to show the information and be transparent with the information, recognizing the limitations of the information. So, you might think of analysis in different phases. So, you first might develop an analysis to try to answer the question, is nuclear power a good idea? Or is this something that we should be looking at? You might call that a rough order approximation. If the answer to that first rough order approximation is yes, then you will get into the very nitty gritty details of analysis moving forward, where you will understand the economic potentials in much greater detail than that first high level estimate. So when you're at that stage of the first high level estimate, it's very imperative that we convey to the decision maker what are the assumptions that we're making about this analysis that we're performing? What's the quality of the data that we're using? What's the limitation of our understanding? What do we think we know versus what do we recognize we don't know? That's very important at those very initial stages of decision making, thinking about deploying nuclear technology in our countries. Once we pass that first hurdle, we will go into great detail in analysis moving forward. But that initial level, we need to recognize the limitations of our understanding and be transparent with the decision makers.
Thank you. The next question says, there's risk in the nuclear industry. When a plant is built, the construction company may eventually disappear. How can we prepare for this scenario?
Great question again. So again, we have to think through the contingencies of what will happen. So if the construction company goes out of business, what is the contingency of that going out of business? This was something that we actually saw in the Vogel plant, that there was a lot of going out of business that was involved in ownership being transferred to another company. It happens. And so thinking through what are those contingencies is a better way to go. But also thinking about what are the incentives that could be structured to incentivize behavior so that that doesn't happen. For example, what happens if we incentivize on-time performance and create an incentive to move in that direction, so that maybe we can move away from the contingency of a construction company going out of business. But yes, definitely thinking through what are the different avenues of possibilities is a required course of action.
Thank you. So here's an interesting question. What lessons can we learn from China's rapid build out of nuclear power plants over the past 2 decades?
Now, when you look at the pace at which the Chinese are building, it's extremely impressive, the rate that they're building the production of their nuclear capacity. So a couple of lessons come to mind. The first one has to do with that slide where I showed a schematic picture of the nuclear reactor. And on that slide, I talked about standardized designs. So if you make an order and you invest in a particular technology and you stick with that technology, that creates opportunities to learn really well how that technology operates. And so on the first installation of that technology, you're going to learn things that on the second installation of that technology, you don't have to go through those same problems again because you learned about it on the first. And then when you build the third one of that technology, again, you have built a, you've created opportunities for additional learning. So that's one thing that I think the Chinese are doing very well is they're taking advantage of those standardized designs and deploy of repeat, repeat, repeat. That's point number one. Point number two is incentive alignment. So with the Chinese builds, all of the different actors that are involved in building a nuclear power plant have this incentive alignment. So they're all oriented to the finish line of building the nuclear power plant. And so making sure that those incentives align properly is key. And I think the Chinese have done very well at demonstrating how to get those incentives aligned across all the different components of the supply chain so that the welders, the constructors, the builders, the pipe fitters, manufacturers, everybody's oriented towards the same finish line goal. So standardize and incentive compatibility, incentive alignment.
So, Jason, I'm going to push you a little bit further because I want to. So you gave some positive lessons we learned. Did we learn any negative lessons?
From the Chinese or from just more broadly? So I didn't hear the second part of your statement, Aleshia, that you got muted there. But I think I was reading your lips correctly. It had to do with standardized.
No, I said so you listed two positive lessons that were learned. Were there any negative lessons that were learned and things that probably should not or could have been done better?
Yeah, so that is kind of pushing me a little bit, Aleshia. So I would say the answer to that has to do also with the standardization that instead of having market forces per se pick out which are the best designs that provide the greatest value for society, that there was not a competitive process associated with that. Competition actually works really well for markets to create value for society, for everybody in society to be made better off. And so to the extent that that competition is negated, then I would say that that could potentially be a negative outcome associated with forcing a decision as opposed to letting the technology bear out in a competitive way.
Right. Thank you. Thank you for being flexible on that. Could you please elaborate on the specific factors that make the SMR OCC greater than large NPPs? Is it just the immaturity of the SMR technology?
Yeah, so this has to do with the discussion of cost behavior again. I'm going to come back to the point about cost behavior. And we've got first of a kind costs versus nth of a kind costs. So with SMRs, the reason that those cost estimates appear higher right now is because we lack data on how they're actually going to work. Until we have a richer data set of demonstrations of small modular reactors, whether that be from Canada, whether that be from the United States, whether that be from Poland, whether that be from anywhere where small modular reactors are deployed, we need that data. And until we have data about how costs change over time, our estimates show that initially they're going to be more expensive than the large reactors on a per unit basis. But as we give those small modular reactors time for modularity, factory fabrication, learning, all those things that we know are attributes of small modular reactors to kick in, that's where we can see the cost coming down over time. But initially, they will be probably higher than what the large reactors are because they've never been built before. So I provided a link, that cost reduction tool that looks at different pathways where you can allow for different assumptions, different what if scenarios about what the cost trajectory might look like for those small modular reactors to come down over time.
Thank you. Next question. So what do you think is the minimum nth of a kind for SMR after they become cheap compared to large reactors?
What a great question. What is the definition of nth of a kind? That's a question that's actually debated in the literature. Nobody has a solid understanding of what nth of a kind actually means. Different people think it means different things, and that has to do with different assumptions that are associated with it. Some people say it could be like 3 or 4 reactors. Other people say it could be as many as 10 reactors. We don't really know. What's important is, what does that transition period look like as we go from first of a kind to whatever nth of a kind turns out to be? What is that between period? And what is that transition? How does the role of design maturity? How does the role of construction firm? How does the role of interest rate? How does the role of supply chain stability? How does the role of all these different factors impact on that transition period? That's going to ultimately answer the question, how long does it take before we get from first of a kind to nth of a kind? But I'll just say that in the literature, because I can't give you a solid answer, in the literature, people are talking about it between 3 and 4 reactors up to as many as 10 reactors.
Thank you. Next question. How do you convince a decision maker to invest in SMRs instead of large nuclear plants if they are cheaper per kilowatt hour?
So there's some things about SMRs, the technology designs of SMRs, that make them very attractive. So let's suppose, for example, that you need to meet a 900 megawatts of load in the application that you're looking at. Okay. If you use an SMR, you can meet that 900 megawatts with installation of 3 different modules. Let's just use that for easy math. 300 module reactor, 3 different times. Or you could build one single 900 megawatt facility. Okay. If you go with the 3 module option, what happens? Well, you can construct the financing package for the first module, get that one built and operational, then construct the financing package for the second module, and so on. You begin to generate revenue with that first 300 megawatts much sooner than if you wait to bring all of the megawatts online at one time. So that's one thing. You can generate revenue faster. You can also create opportunities for learning to take place. By going from 1 to 2 to 3, you create opportunities for learning versus everything gets built at the same time for the large 900 megawatt facility. So it creates some flexibility that large power plants don't have. So there's trade-offs associated with both of them. It depends on which ones that you're most interested in. What are the most critical issues that you're after?
Thank you. So there's a comment that says, thank you for the insights. Loved it. Given the increasing impacts of climate change and the potential decline in water availability, how are these risks factored into the economic and financial analysis of SMRs? And what implications might this have for overall cost and feasibility of deploying nuclear technology in developing countries which are pushing for nuclear?
Yeah, what a very important question. Water, how does the impact of water play on that? So in the cost estimates, in estimating the capital costs as well as in the operation and maintenance costs, the procurement of water to cool the plant is a component that you'd have to factor in there. How much does it cost to procure enough water or enough water rights to be able to have that operational in your plant? I mean, to use that as an input into the power plant. So the other thing to bring up there is that based on different technology design types, they have different water footprints associated with them. So depending on how the cooling is designed, some of them have different water. I mean, they don't all have the same amount of water requirement. So if you are thinking about a nuclear power plant in an area that is where it's very water scarce, that's going to point you to a particular design type that will be different than one that requires a higher amount of water in their cooling facilities. So that's a trade-off that can be factored in terms of cost and also in terms of technology design when you look at what the cooling requirements are and how the system is designed.
Thank you. So in terms of comparing the cost of variable renewables and nuclear, is it good to make such a comparison considering their time of construction years of operation or lifespan, and all of the other parameters.
This is getting at the limitations aspect of the LCOE that I mentioned, and these are important limitations to keep in mind. So oftentimes LCOE is the metric that gets used. And where is it appropriate and where is it not appropriate? Well, it's appropriate when you're comparing within a technology set. So you're looking at one nuclear technology type compared to another nuclear technology type. But when you look at using LCOE to compare nuclear technology to solar or to wind only on the basis of LCOE, there are some very important limitations that LCOE does not capture. For example, the reliability aspect. Solar and wind are not available 24 hours a day. And so does the cost number for solar and wind include with it battery backup or storage? Is storage included with the LCOE number? Another aspect that's not captured in is the quality of the electrons that go onto the grid. So the frequency of the grid in the United States has to be maintained at 60 hertz, I believe it is. And if there's any variation in that, the electricity will start to zap our electronics. It'll fry our computers or our phones or whatever we're using the electricity for. So that hertz, that frequency is very important to maintain. And renewables don't all put on the same hertz at the same time. So nuclear power can be used to offset that frequency regulation associated with renewables. Well, that cost is not attributed to renewable electricity, nor is the benefit monetized and attributed to nuclear. It's what we would say in economics is a non-market benefit. So it's a benefit that exists, but it's not quantified. And so those begin to get at some of the limitations of comparing nuclear technology to renewable technology only on a cost basis. Let me just conclude that point with saying that the lifespan also matters. A nuclear power plant will operate for 80, can operate as many as 80 years. Well, solar panels and windmills will not operate for 80 years. They have to be replaced. And so the life cycle of the solar facility, the life cycle of the wind farm is not typically attributed to the LCOE number that is used to measure the cost of renewables. So the life cycle component doesn't factor in. So I mean, I guess that's all to say, Aleshia, that it's getting into the limitations of the using LCOE across technology types.
Thank you. Next, can you broadly list key components of how cost-benefit analysis framework can be built to inform whether a large conventional nuclear or SMR benefits the society as compared to building a large-scale solar plus storage or gas power plants? And please speak to the fact that there are large advanced reactors in the Gen 3 plus fields, because I think that's often a misconception of people that conventional means old.
Yeah, great question. This gets at a whole topic that I didn't even cover in the presentation that I went through. It has to do with economic impacts in the region. Okay, so as was mentioned in the opening a few years ago, I led some research on looking at the differences between coal power versus nuclear power. There was a substantial benefit in terms of economic impact to a region where nuclear power is deployed. It requires a lot of jobs to operate a nuclear power plant. These are jobs that have stable salaries, that create wages that get spent in the community. And that spending in the community has a ripple effect, an economic multiplier effect that enhances the economic opportunity for a region where nuclear power gets deployed. Okay, because of the fact that nuclear power is very capital intensive, but once you invest in it, the operational costs are much smaller relative to the fixed costs. You just need people to operate the plant. Where are those people? I mean, those workers that operate the plant, their economics, their household economics, their kitchen table economics of those power plant workers drives economics in the region. And when we look at other energy technologies, the economic impact to the region is not the same. It just flat out is not the same. For example, an equivalent sized gas plant requires like 25% the amount of people that a nuclear plant does, much less people. A renewable plant, even less. So that if you're concerned about economic opportunity in a region, if you're concerned about the quality of life for the people who live near the power plant, the economic impacts are a very important aspect to measure in terms of what does it do to the tax base and the revenues that circulate in society where those different technologies are deployed.
Thank you. Do you perceive that the cost of capital would decrease if more and more nuclear projects are financed through some sort of bank or governmental loans, so that this trend would outweigh the negative effect on the interest rates of increasing demand for available and competitive financing?
Yeah, so that slide where I talked about the loanable funds market going forward, what are we going to see happen there? Well, we're going to see that because there's so much demand for loanable funds to finance nuclear power, that those who loan funds are going to require the economics to be very competitive for the borrowers. But also, what's going to happen is that people are going to see that there's stable, reliable economic opportunity with investment in nuclear power. So there's going to be, there will be, I mean, this is just how economics work over time going forward. There will be an increase in the amount of loanable funds available to attract that. So, one of the neat things about how markets work is that dollars follow value. And so as value is demonstrated in investing in nuclear power plants, not only will the demand for investment is going to push up the interest rate, it's going to make the demand for money increase, which is going to make the interest rate rise. But the fact that the interest rate is rising is going to attract suppliers to loan money to that investment community, and that's going to have downward pressure on the interest rate. So yeah, I anticipate that based on those IAEA projections about what investment will look like over the near term, medium term, and long term, that we will see some evolution associated with the investment in nuclear power. The other thing to think about there is that opportunity cost that I talked about. So once nuclear is demonstrated as a safe investment opportunity that plays out over a long period of time, think about that relative to the volatility of placing your investment someplace else. Then nuclear becomes a very attractive asset. So as economic turbulence might heat up in different regions globally, nuclear becomes a safe haven for investment because not only is the technology known, but the economics will bear out as that evolution goes forward as well. So I think we'll see pressure up on interest rates, but also pressure down on interest rates as financing is attracted to nuclear investment.
Thank you. What financing models, for example, PPA, have proven most effective for introducing nuclear in regulated markets?
Yeah, so that guaranteed rate of return, that's the mechanism that you have to demonstrate to the regulator that what will be the cost consequence for your customers associated with that. In the case of Vogtle, for example, I read some studies that I believe it's on the order of 7%, that the average household utility bill in the region where electricity is provided to customers of the Vogtle power plant, their electricity bill went up by about 7% on an annual basis. Okay. In return, what did they get? Stable, reliable power for 80 years. So there was an increase in their bill, 7% on their bill, so $10 or so on a monthly basis, in return for stable, reliable power going forward. Those are the kind of things that those will be the kind of things that a regulator will be looking at going forward, is the stability of what can their customers expect going forward. So in terms of a PPA, that will definitely play a role. The regulator is concerned about households and customers. So when we talk about PPAs in terms of PPAs for industry or PPAs for data centers, it's not quite clear yet how that's going to bear on the regulated aspect in terms of what a state regulator might have to say or an economic regulator might have to say, because that's outside of the scope of bearing on households and end use customers. I think the thing that will have to be important is that PPA, whatever PPA gets demonstrated, the incumbency will be to demonstrate that the rate base, that the customers are not negatively impacted by the implementation of a PPA for industry or other industrial applications.
So, Jason, thank you so much. According to what I see as the schedule, we were supposed to have concluded this entire meeting 15 minutes ago. I am struck by the number of questions that continue to come in, and that means we need to talk about this yet again. So perhaps we'll do a deeper dive with you in the near future, if that would be okay. I can
Sure.
tell that there is great interest, not only by the questions, but by the number of participants that are still hanging in there with us at this time, and we've gone over. I want to thank you for joining us today and appreciate you so much. And we will definitely be back in touch to do a round two of this conversation. I also will say to those who will be joining us in Idaho for our Advanced Reactors Summit, that is the home of Jason. And so who knows, you might even run into Jason there. So, Jason, thank you again today, and I appreciate your time. And we're all giving you a warm round of applause.
Thank you, Aleshia. Always nice to
Thank
see you and appreciate the invitation to discuss these things.
Thank you so much. And we will make your slides available to the group. Thank you so much for joining us. All right, so we're going to move to very quickly to the next part of the meeting, which is the very brief logistical overview that our dear So-Young will provide us with on the Idaho National Laboratory workshop on that will take place at Idaho National Laboratory. It's the IFNEC Advanced Reactor Workshop. I'll turn it over to So-Young. So those who are going, who are registered, this part of the meeting is for you. Those who are not already registered, the registration has closed. So you may feel free to drop off. And So-Young, I'll turn it over to you. Thank you.
Thank you, Chair. In light of the time that has passed, I will try to make my presentation as brief as possible. Good afternoon, everyone. This is to quickly remind you of a few important logistical details to help everything run smoothly for the upcoming IFNEC workshop on advanced reactors. This workshop is scheduled from Monday 6th to Thursday 9th of October at the U.S. Idaho National Laboratory. Kindly note that the participants are encouraged to arrive on Saturday 4th October to avoid any issues due to flight delays or cancellations. We will soon circulate the updated agenda to confirm your availability for the proposed sessions. Your prompt response will allow us to finalize the program in a timely manner. Also, a cultural excursion to the Grand Tetons is scheduled on Sunday, 5th October 2025. The information form has been sent to all the registered participants, and it will be greatly appreciated if this can be filled out and submitted to the IFNEC Secretariat by the end of this week. The airport you need to fly in is the Idaho Falls Regional Airport, which is a small airport providing direct flights to these 5 cities. We recommend that you review both delays and cancellation histories for your chosen flights before making bookings, as there may be a delay of up to 14 hours when waiting for the next available flight into Idaho Falls. The weather in October in Idaho Falls can be quite unpredictable. We advise you to check the 2-week weather forecast in advance and wear accordingly in layers. At the INL facilities, there are clothing requirements and prohibited items. To check more details, please refer to the information sheet provided to all the attendees earlier upon registration. In addition to core workshop activities, a special ceremony will be arranged alongside the main sessions to recognize countries that have newly joined IFNEC, either as observers or as participants. We look forward to celebrating the new observer and participant countries and to a productive and engaging workshop for all. Thank you.
Well, that was perfection, So Young. Thank you. So obviously the IFNEC Secretariat remains available to you. We are so excited that you all are coming to see us at our crown jewel of Idaho National Laboratory. We look forward to the discussions, the fellowship, and the technical tours and all of the great things that are planned. And I want to also make sure that you are aware that this is a really important opportunity for us as the IFNEC community to get together to talk about advanced reactors and all of the many areas that are, a part of that conversation. So we look forward to seeing you. We thank you for joining us. We will provide the slides for this presentation today, and we wish you a great rest of your day. Thank you so much. Take care.